Let's get started. Now, so far in this course, you have learned about the different cost categories, direct costs, indirect costs. Then you learned that direct and indirect to the cost object. Then you learn the three categories of costs for a manufacturer: direct material, direct labor, and overhead, product cost, and period cost. Then, first part of this course, we looked at cost accumulation systems. We started with job costing. We introduced process costing as well. But with job costing, you understood that we could trace the direct costs and measure them exactly, and that was direct material and direct labor. The problem were the indirect costs in overhead. All overhead costs are indirect to the cost object, which is my production of my product. Okay. Then a more sophisticated cost accounting system was the activity-based costing, where we still trace the direct material and direct labor, but we divide up the overhead into those costs that are similar, and we look for a cost driver, and we use that cost driver to assign the cost. Now, these cost drivers are basically different activities. So we come up with a cost of activity, and then we observe how many activities are consumed in the production of this product, how many is consumed in the production of that product, and in that way we assign the indirect manufacturing overhead costs to the products. Then I took it one step further. I said, hey, look, we can apply this idea to the period costs in a business. That is the non-manufacturing costs, the cost of running the IT department, the cost of running the marketing department, and so on. We can look at all the activities in that department and attempt to come up with a cost per activity. And the goal here is not to measure so much. Our goal here is to manage. You can't manage something unless you're in a position to measure it. And so our goal here was to manage activities, and realizing that activities consume resources, and therefore we're going to look at those activities and determine if those activities add value to our product or our service, or do not add value, non-value added. And then as a manager, you can begin to manage the non-value added activities and reduce the cost without having any impact on the product or service that we're providing our customers. So that's how far we've gone so far. Now we're going to switch gears. We're now, if you can picture, as I did in the first lecture, the income statement of a company. Of course, we call it the statement of operations. However, the top part is revenue, but we're concerned with all the expenses that are incurred by a company in the year. That is product costs and period costs. So the cost of goods sold are the product cost expenses that we've concerned: direct material, direct labor, and overhead. And selling and admin were the period costs. So we're looking at all the costs, and we take a look at manufacturing overhead, all the costs involved in manufacturing overhead. And we now want to distinguish between these costs as to which costs are variable, and we'll define a variable cost, and which costs are fixed. And so therefore, in this module and the next one and the next one after that, we are going to be looking at cost behavior. If as managers we can understand how costs behave in relation to an activity, then if I increase that activity, which costs will increase and which costs will not increase? And that's my goal. My goal here is to analyze every expense, we call them costs now, that is incurred in a business, and distinct and determine which ones are variable and which ones fixed. And we introduce a new concept called contribution margin. So that's where we're going today, cost, behavior, and the contribution margin. So you're introduced now to not only new concepts, but new language, the language of managers. These are terms that managers use quite often. So that's what we are today. Okay. What we're talking about is cost behavior analysis. And that is the study of how costs, specific costs, respond to changes in the level of business activity. Okay, so the business activity is my cost object, basically. And basically, to use that word too loud, we're going to be talking about business activities such as sales, business activities such as production. So for the rest of it, we're going to talk either sales or production. If sales increases on my income statement, what costs on my income statement will increase and which costs will not? If I decide to increase my production of the products, which costs will increase and which costs will not? Some costs will change and others will remain the same, will not change. And knowing this helps management plan. This is what we're talking about. This is a very useful planning tool. Plan future operations. That's the role of a manager, to plan operations. And they may have different courses of action that they're looking at, and this helps them decide between the alternative courses of action. All right. So this technique, this cost analysis, we're going to talk about it in relation to a manufacturing company, but as I always say, it applies to all types of businesses. Okay. Sole proprietor, partnership, and manufacturing, and entities, profit-making companies, nonprofit, government. And the key thing, of course, now is measuring business activity. As I said before, that activity can be anything, but basically we're going to focus on sales dollars or production, miles driven, whatever. Okay, many companies use, of course, different bases depending on what they want to analyze. All right, that's where we're going. So we now want to break all the expenses in a company into those that are variable and those that are fixed. So we start with variable. Now, costs that are variable, that is, that change, and here are the key words: in total, directly and proportionally with changes in the level of activity, are variable costs. A variable cost is a cost that will change in total, directly with changes in the activity, and proportionally with changes in the activity. Proportionally means that if the activity increases 10%, the total variable costs will increase. The total variable costs will increase 10%. If the activity level decreases 25%, the total variable costs will decrease by 25%. That is the definition of a variable cost. Now, for example, let's presume I'm manufacturing a typical school desk, you know the ones you've all sat in. There's wood, and then there's metal that's bent, and there's a plastic chair that you sit in. And I'm a manufacturing company that manufactures desks, all kinds of desks, but I'm going to focus now on this typical desk. All right. And I'm going to then just look at the costs that go into the desk, all the costs that go into that desk. And for example, now let's just take wood. We know that wood is a direct cost in the manufacture of that desk. Why is it direct? Because I can measure it. All right. And I measure it and I know exactly how much it costs. Let's say it costs 50 dirhams for every desk. So if I produce one desk, the total variable cost for wood would be 50 dirhams. If I produce two desks, the total variable cost for wood would be 100 dirhams. If I produce 10 desks, the total cost for wood would be 500 dirhams. So you see, wood is a variable cost. It increases in total in direct proportion to increases in the business activity. And this business activity is the production of desks. So if I double production, the total cost doubles. If I 10 times the production, the total cost goes up 10 times. That means that cost is proportionally related to the business, to the level of activity. So that meets the definition of a variable cost. So when we're looking at predicting the future and we want to know which is variable cost and which is not, the definition of a variable cost is a cost that will vary or change in total. Now, the other thing about a variable cost, as it says down here, variable costs remain the same per unit at every level of activity. So, what do I mean by that? Well, I'm looking at wood. I've determined that wood is a variable cost, and it's 50 for the desk. Now I produce one desk. The unit cost, notice we're talking the unit here, not total. The unit cost is 50. If I produce two desks, the unit cost is for wood is 50. If I produce 10 desks, the unit cost is 50. So you see, wood is a variable cost because it changes in total, but a variable cost also remains the same on a per unit basis at every level of activity. And that is the nature of the variable cost. Let's assume Damon Company manufactures tablet computers that contain a $10 camera. The activity level is the number of tablets produced. As Damon manufactures each tablet, the total cost of the camera increases by 10. And as you can see here, that if I produce two tablets, the total cost is 20. If I produce four, the total cost is 40, and so on. Okay, so I'm able to predict what the cameras will be. If I produce 2,000 units, I know that the cameras would cost me in total 20,000. Okay, that is the nature of a variable cost. However, the activity level is the number that Damon manufactures the total camera, but here you see we're talking the unit cost. The variable cost per unit is $10. And it doesn't matter how many cameras they produce, 2,000 or 10,000. The unit cost will remain the same. And that's the nature of a variable cost, that it changes in total, and that's the definition of a variable cost, but remains the same on a unit base. So if I graph it, on the left-hand side is the total variable cost graph. And on the right-hand side is the unit, variable cost per unit graph. Okay? And the quicker you are, the more points you get. The cost which remains constant per unit at various levels is a variable cost, a fixed cost, and a mixed cost. Now notice it says per unit. Ah, it's a variable cost, not a fixed cost. You think because it says remains constant, it's fixed. No, don't be fooled by that. You have to look on it on an unit basis. That's the key thing. Okay? I'm sorry about that. Now, the second category are fixed costs. A fixed cost remains the same in total, regardless of the changes in the level of activity. So back to my example, I'm manufacturing these school desks in a factory that costs me 10,000 dirhams a month. If I produce one desk, the total cost for rent is 10,000. If I produce two desks, the total cost is 10,000. If I produce 1,000 desks, or let's say 100 desks, the total cost is 10,000. So you see the cost rent that I'm analyzing is a fixed cost because it remains the same in total, regardless of the change in the production activity. But on a per unit base, the cost goes down the more I produce. As it says here, the per unit cost varies inversely. What varies inversely means with activity, as activity goes up, the unit cost goes down. All right. So if I produce one desk, the unit cost is 10,000. I divide the 10,000 rent by the production, one desk. If I produce two desks, the unit cost now becomes 5,000. I divide the 10,000 by the number of units. If I produce 10 desks, the unit cost becomes 1,000. If I produce 1,000 desks, the unit cost will become 100 per desk. So you see the unit cost goes down as activity goes up. And that's the nature of a fixed cost. The more you can put through on a fixed cost, that is production, the more the per unit cost, if it's fixed, will be. It will go down. Examples, I used rent, I could have used property taxes, insurance. All of these are fixed costs. And they will remain the same in total, regardless of the production. But if I'm looking at it on a unit basis, it will go down as production increases. So that's the difference. So back to our Damon Company manufacturing tablets. As I said, they lease the productive facilities for 10,000 a month. Total cost remains 10,000, regardless of what the production. If I produce 2,000, 4, 8, whatever, 10,000, the fixed cost will remain the same. However, the more I produce, the lower the fixed cost. All right. So when you look at the graph for fixed cost, it is on the left-hand side, the total graph shows that fixed cost is constant. On the right, it shows that fixed cost is changing inversely opposite to the level of production. The more the level of production, the less the unit cost. So I have the nature of the variable cost and the fixed cost. So questions now. Please join in. Fixed cost is a cost which remains constant per unit with changes in level of activity, varies inversely in total. In total, it says, remains constant in total with changes of the level of activity. Now pay attention to in total and per unit. Okay. Wow, my goodness here. 4 out of 10 people, 4 got it right. 6 people got it wrong. It remains constant in total with changes in the level of activity. Fixed costs normally will not include property taxes, direct labor, supervisor's salary. Yeah, that's a little better. Very good. Good. Okay. People. Question 5 out of 14. Increased use of equipment, automation, and less use of workforce in companies have caused a trend towards an increase in both variable costs and fixed costs. Causes an increase in fixed costs and a decrease in variable costs, or causes an increase in variable costs and no change in fixed costs. Now this is called being capital intensive. Pretty good. Yeah, the answer is fixed cost. If I put in more machines, depreciation is the cost of those machines. That's the expense. Depreciation is the expense of using those machines. And that expense is a fixed cost. All right. Workforce, that would be direct labor, is a variable cost. So the answer here, of course, would be the increase in automation and the less use of workforce in companies, because I've replaced the workforce with equipment. When I replace the workforce, that's a variable cost. With equipment, that's a fixed cost. So as companies automate, the cost trend increases the fixed costs and decreases variable costs. So remember, it comes into play later as well. You should be good. All right. Okay. Let's go. Now, when we talk about fixed costs, we have to bring in another concept. And that concept is called relevant range. And it relates only to the fixed cost. Okay. The fixed cost, and what that basically means is this. I'm back to my factory and I'm manufacturing desks. And the cost is rent. And as I said, if I produce 100 desks, the cost is $10,000 for rent. If I produce 500 desks, the cost is $10,000 for rent. If I produce 1,000 desks, the cost for rent would be $10,000. But now I'm at the limit of my capacity. That is, if I want to produce 1,200 desks, well, my fixed cost is no longer $10,000. I have to add capacity. I need a bigger place. And so my fixed cost rent will change. And that means that you have to add capacity. So when we talk about fixed costs, we are assuming that we are within that relevant range of production. And that relevant range is basically what management has decided should be their capacity. And therefore, we're always working within capacity, all right? And so that's an assumption. Once we go outside of it, as you can see, the total fixed cost will jump. Here's a better idea. So the relevant range of capacity on the right-hand side here, between 0 and it looks like 30. But once I go beyond 30, I need more capacity. So fixed costs will jump in total and then remain the same until a certain level, and that is that relevant range of activity, and then they would jump. Okay, so that's the situation. And right now we are producing between 40 and 80, and that is within the relevant range of production, because the relevant range you can see is between 30 and maybe 85 here. So we always talk about the relevant range when it relates to fixed costs. On the variable costs, it's not so much it's curlinear, but we don't get into that too often. We just keep it straight. Yes.
I have a question on the relevant range. If you can go back.
Whoa. Okay, let's see if I can go back. Yeah, go ahead.
Yeah. So here for the total fixed cost, now we see that there are two jumps in the fixed cost. So it means that the capacity has increased from like between 40 to 80%. So here they have increased capacity.
Sometime in the past in this company, they might have been a small company, and originally the relevant range would be the lower one, 0 to 30. You know what I'm getting at? That would be the relevant range at that time. But then there came a point where they had to increase production rather dramatically, and they moved up the cost, they added capacity. And now the relevant range of activity, that's the range that the company will operate in. They would basically stay within that relevant range. All right. If they go outside the element, they have to add capacity. That's what that graph is saying. But when we're analyzing fixed costs, we assume that we are within this relevant range. It looks like, the relevant range is 35 to about 85, and we are well within it. Now, many companies, all companies, operate below full capacity. When a company says they're at full capacity, it's not quite true. They generally mean they're about 80% capacity, okay? And
but here, Doctor, they say like the relevant range is from 40 to 80, but even if they operate at 20%, the cost will not change. So based on what they have, like based on what is chosen, like from 40 to 80, is there a
well, generally a company won't operate at 20% of. You see, management doesn't add capacity. First of all, it's two things. Management always adds more capacity than they need, because the capacity, they do the analysis now. I need 30,000. I need 30,000 square feet. And that's to satisfy the demand they have now, but they never add fixed costs to that. They always add more. All right. Now, when they operate, they know what they're going to be operating in. I mean, operations will not drop down to 20%. Operations will stay in this 80% range. And as long, or this, look at the range is anywhere from, looks like 40 to 85, no, 40 to 80. They will stay within that range for a long time. And all that time, then the fixed costs are assumed to be fixed, that we are not operating way below our capacity, and we can't operate way above our capacity. We need more capacity. Okay.
Okay.
So this concept relates to fixed costs. That is, the fixed costs will remain the same as long as I'm producing, in this company's case, anywhere between 40 and 80. And that generally, so you see 85 would be full capacity at this point in time, and we're below that. And generally speaking, we just built a campus here in LA, and we added the new campus. Well, we added much more capacity to that campus than we need in the year 2021, 22. But you see management's putting in place capacity for 10 years down the road, 15 years down the road. But nevertheless, the capacity is there. We're still operating at about 75% of the capacity. And at all that time, the fixed costs would remain fixed because of that level of activity. Okay? All right, jump in here. Good, good. By the way, that's a good question about relevant range. Relevant range is a concept. The relevant range of activity refers to activity levels where all costs are currently eliminated. Levels of activity over which a company expects to operate. Now, this might be tricky. Level of activity where all costs are constant. Not all costs. We're only talking fixed costs. So that's a tricky question. Let's see how well we all did. Yeah, of course. Relevant range refers to the production activity over which a company expects to operate. Some people are not happy with that. All right. Now there's a third category of costs, which are called mixed costs. Called mixed costs because they're both fixed and variable combined. The total cost is partly fixed, and you see in the graph the green area down here, and partly variable. And that, looking at the graph, you see at zero level of activity, there's still a cost, 50. But as the activity increased, the total costs increase. So you see, a mixed cost will change. It will increase. But unlike a variable cost, the mixed cost will not change in proportion to changes in the level of activity. In direct proportion. It will change, but not in proportion. You know yourself, if you're looking at the electricity costs in a factory, and the more work you do in the factory, the more the electricity costs go up. However, if you do nothing, shut it all down, there's still costs, electricity costs involved. So you see, electricity would be a little bit fixed, but largely variable. So there's a proportion is fixed and a portion is variable. Now, we cannot work with a mixed cost. What we have to do is break it out into that portion which is variable and that portion which is fixed. I didn't realize I had a question here. Which of the following is not a mixed cost? Depreciation, electricity, telephone expense. What do you think is not a mixed cost? Okay, yeah, oh, yeah, good. No, a telephone expense. If in a business you have a telephone line and you don't even use it, you still pay. And the more you use it, the more you pay. Electricity, no, I just gave you an example that electricity is a mixed cost. So is telephone expense. What is not mixed, but is fixed. All right, first of all, we have to identify the costs we're talking about. And so here we have Helena Company, and they have total cost at 2 levels of production. Classify the variable, the fixed, and the mixed. So here's the level of production, 10,000 units and 20,000 units. Okay. Let's take the first cost, direct materials. At 10,000 units, the direct materials will cost them $20,000. If I double production, Well, the direct materials will also double to 40. So you see, direct materials would be a variable cost. It changes in total, indirectly and proportionally with changes in the level of production. Maintenance at 10,000 units was $8,000. At 20,000 units is 10,000. So look at that. Maintenance changes. It's not a fixed cost, but it's not a variable cost. It goes from 8 to 10. It changes, but not in proportion. It did not double with production as direct materials did. It increased, so it is not a fixed cost. Direct labor, 17,000 at 10, 34 at 20. Yeah, it doubled. Indirect materials, 1,000 and 2, it doubled. So those two are variable costs. Depreciation did not change. Utilities did change, but not proportionally. All right. Utilities, electricity, light, AC would all be under utilities. Rent remain the same. So you see the variable costs, direct material, direct labor, and indirect materials. Fixed costs, depreciation and rent, maintenance. So now we have, they classified the cost. But as I said, we cannot work with a mixed cost. So we have to break it out into that portion of the cost that is fixed and that portion of the cost that is variable. How do we do that? Well, we use what's called the high-low method. That is, we look at the total cost. If I wanted to go back, I look at maintenance at one level of activity and maintenance at another level of activity. The difference between these two costs is the variable portion, because the variable portion is the only portion that changes, the fixed does not. So now I select two levels of activity, and basically that is the high level of activity and the low level of activity. And I look at the costs at the high, and I look at the costs at the low, and the difference between those costs is the variable portion. It's the only one that's changing. And so the formula here for the high-low method is, first of all, determine the variable cost per unit. How do I do that? Well, I take the costs at the high level and the cost at the low level, and I get the change in total costs. And then I take the change in activity. I subtract the high level of activity and the low level. And in that way, I get the variable portion per unit. An example here, we have Metro Transit has the following maintenance costs and mileage data. So this is what we do with the mixed cost. This is what an accountant would do. And that is keep track of this mixed cost over a period, let's say 6 months, and track it. And 1 month we did 20,000, the cost is 30,000 in maintenance. Hello. Got your mic on. Look, the activity doubled from 20 to 40, but the cost did not double. So this is a mixed cost. And I take the readings and I say, okay, look, at the high level of activity, 50,000, my costs were 63,000. At the low level, 20,000, my cost is 30. So now, first of all, take the change in cost, 63 minus 30, and I get 33,000. That's the numerator. For the denominator, I take the change in the activity, and that is 50,000 miles minus 20,000, 30, and I get $1.10 per mile, per unit. In this case, my unit is miles. So you see, I take the high level of activity, not the high dollar, the high level of activity, and the low level of activity. All right, that gives me my variable. But you see, a mixed cost is partly variable and partly fixed. So I know that the variable portion is $1.10 per mile. So now let's work backwards and figure out the fixed. So let's take the high. The high was 63,000. Now that 63,000 is partly fixed and partly variable. And that's what it was at 50,000 miles. So I know the variable portion then is 50,000 miles times $1.10. So of that 63, 55 is variable. Therefore, the remainder is fixed. I can test that by looking at the low. At the low, the total was 30,000, and I know I did 20,000 miles. So I multiply it by $1.10, I get 22,000, and as the variable, my fixed is 8. Of course, fixed is fixed at every level of activity, within a relevant range, of course. Remember, fixed does not change in total. So now I'm able to break maintenance cost into its fixed portion, which is $8,000 per month, and its variable portion, which is $1.10 per month. And that's what I want. I want to break all my expenses into those that are fixed and those that are variable. And mixed costs have both a fixed and a variable portion. But I know now, roughly speaking, $8,000 and $1.10 per mile. I can also use this now to predict what my maintenance cost would be. It's going to be, you tell me the miles driven, and I'll tell you the costs total. You say 45,000 miles, okay. The total cost would be 8,000 fixed plus 45,000 times $1.10. So your total cost would be 57.5. And that's how I break out the high-low method. Now, make sure you understand that method. Now, if you're mathematically inclined, which a number of you are, you would recognize that this is the formula for a straight line. What I've done is I've plotted the actual costs on a graph against the miles driven. And I take the high and I take the low and I draw a straight line between them and see where it intercepts the axis down here. And that portion would be the fixed, and the slope of the line is the variable. So basically what I've stolen from the mathematical people is y, which is what I want to predict, is equal to the fixed cost plus b, the variable cost, times x, which is the activity. Okay? So that's high-low. You shall be responsible for that. Let's get people involved here again. Let's get some more questions. Is that another prayer call? Okay. 17. Question number 9. Using the high-low costs method, the fixed cost is determined by adding the total variable cost to the total cost at the low level. Is determined before the total variable cost. Is determined by subtracting the total variable cost from either the total cost at either the high or the low. What do we got? Yeah, no, the answer is we determine the fixed cost by subtracting the variable cost from the total. Some sad faces here, some happy faces. Make sure you. All right, now we move in to something that's very important for us as management. We're back to the income statement. And we have what's here, a Fargo income statement, the year ending. Sales, 1,600 units, 800,000. Cost of goods sold, that's direct material, direct labor, overhead, whatever, 520. Selling, 100,000, and administration, 60. So I have a profit of 120. Now, you would recognize this, of course, from your financial accounting course. This is the way an income statement is presented to the outside world so that people will understand what has been going on in the company, or at least get an idea of what's going on in the company, and determine the profit. So this format follows generally accepted accounting principles, and for financial accounting purposes, it's perfect. But for our purposes, it ain't perfect. It doesn't give us the information we need to predict. If I increase my sales from 800 to 900, what would my cost of goods sold be? Would it go up or down? What would my selling be? What would my admin be? What would my profit be? I can't estimate that in the format that I have here. But wait a minute, I just went through the whole company and I determined what was fixed and what was variable. That is, I went to the cost of goods sold, and I'm a production company, and I looked at direct material, that's variable, direct labor, that's variable, and the overhead. Now the overhead is some of the overhead, they're all indirect costs, but some are variable and some are fixed. And I broke out those that are fixed and those that are variable. I went to the selling and expenses, the period costs area, and I broke out those selling expenses that are fixed, salaries, those selling expenses that vary, commissions. I go to administrative expense, I break it out. So you see, I've broken all these expenses into those that are fixed and those that are variable. So now I'm going to rearrange my income statement into what I call a cost volume profit. For short, you see CVP, income statement. Now this is only for us managers. This doesn't go outside our company. But I haven't changed anything. Sales is still 800,000. The profit is still 120,000. But look, the cost of goods sold was 520, and I determined that of that 520, 400 is variable and 120 is fixed. So I separate the variable and the fixed. I do the same with selling. The selling was 100,000. I look and I say, okay, of that 60,000 is variable and 40 is fixed. I do the same with administration. So what I've done is I've lumped the variable ones, I categorize them together, and the fixed are categorized together. Same total expenses are 680,000, but I now broke in, of that 680, 480 is variable and 200 is fixed. Now I look at that, and a variable cost is a cost that will change in direct proportion. So hey, wait a minute. If this goes from 800 to 880, it goes up 10%. My variable costs will go up 10%, increase by 48,000. But my fixed costs will not. They remain the same in total. Therefore, my profit will go up by that 10%. Okay? No, more than 10%, I guess. But you see, now I can predict what my profit with the sales increase. Now I'm dealing with three things here: sales and variable costs and fixed costs. Well, I know that the variable costs move in the same direction and the same proportion as the sales. So I can net these two together, subtract them, and deal with only one number here. What's that number? We call it contribution margin. Do not get confused. That's not gross margin. That's financial accounting. This term, contribution margin, is a management term. It's not a financial accounting term. You will never find it on financial statements. All right, even the problems I give you, I'm not going to tell you what the contribution margin is. You must, in order to solve the problem, figure out what the contribution margin is. So this 320, we call it a contribution margin. It's not profit. It's contribution to what? To fixed costs. Fixed costs are not going to change. So of the 320, income's 800,000. I pay my variable costs. I have 320 left. I pay my fixed costs. I have a profit, 120. So this concept is a very useful concept to predict what's going to happen in the future. Because I know the way variable costs will move and I know fixed costs will not move. But I can go one step further. This called the contribution margin in total is what it's meant. I can go per unit. The variable selling price obviously is 500, 800,000 divided by 1,600 units. And the variable expenses are 300, 4,800 divided by 1,600 units. So you see my contribution margin per unit. This is contribution margin in total. This is contribution margin per unit. So I've done all of that because I'm able to break out the fixed and variable costs in my business. Okay. So here's an example. What we're talking about, selling price 500, variable cost 3, 200,000, 1,600 units sold. Well, there is my CVP statement in very short order. 800, 40, contribution margin. So all you have to do is look at the contribution margin now and relate it to the fixed cost to get your profit. If this goes up 10%, this goes up 10%, that goes up 10%, that doesn't change, this does. Okay? And that's how we use that to predict. Again, contribution margin is available to cover the fixed cost and contribute to profit. The formula I showed you is unit selling price 500 minus variable, unit variable 300 gives me the contribution margin per unit. And therefore, and this is part of our next lecture, we can predict what level of activity do I need to get zero profit. Well, to get zero profit, I simply need, the fixed costs are 200,000. So I simply need 200,000 in total contribution margin. And if my unit, if I get 200 for every unit I sell, then how many units do I have to sell to get 200,000? Of course, the answer is 1,000. So that gives me my break even, which is zero profit. But as you're going to see later on, we want to predict a profit. So you see, every unit I sell beyond break even, now remember break even was 1,000 camcorders, every unit I sell, I earn beyond 1,000, 200 in profit. 200 in profit. The contribution margin per unit becomes the profit beyond break even. And that, too, is a very way of knowing. Now, one more thing that you must be familiar with. You have the contribution margin in total. You then have the contribution margin per unit. We now put it in terms of ratio. Contribution margin ratio. It shows the percentage each sales dollar is available to cover the fixed and give me profit. Now, just to back up, in management, anytime you hear the word ratio, it means percentage of sales or selling price. If I say, if I asked you, what's the gross profit ratio in financial accounting? It's the gross profit divided by the selling price. If I ask you what the net profit ratio is, it's the net profit divided by sales or selling. So if I ask you what the contribution margin ratio is, it's the contribution margin divided by sales. Now, either in total or on a unit basis, the same percentage. So on a unit, I take the contribution margin per unit, 200, divided by the unit selling price, 500, and I get a contribution margin ratio, all right, of 40%. All right, that means if I went back to my formula, you would see here, whoa, way back. All right, 320 as a percentage of 800 in total is 40%. If I do it on a unit basis, it's 40%. So the contribution margin remains the same on a unit or total. All right. Therefore, in the CVP station, it's always, sales is always 100%. What's the variable cost ratio? Variable cost, which is 60, which is 300, as a percentage of sales, 500, it'll be 60%. And the variable cost ratio always remains the same, unless you change the selling price or you change the egg. In CVP analysis, the term cost, volume, profit. The term cost includes only manufacturing costs, that's product costs, includes manufacturing costs plus selling and admin or period costs, or cost means the cost of goods sold. Older man, you're not happy. What's the matter? Hey, oh, you all do my heart good. Yeah. Good, 15 out of 15. We got 4 more. Okay, to which function of management is CVP analysis most applicable? Planning, controlling, or directing? Oh, no, not controlling, it's planning. I'm trying to predict the future. I want to estimate what sales I need in the future. I want to determine the cost if I want to produce or sell so much. No, it's not controlling. This tool is a planning tool. A company has a contribution margin get your calculators out, per unit of $60 and a contribution margin ratio of 40. What is the unit selling price? Well, if I knew the contribution margin per unit and contribution margin ratio, I divide one into the other. Is the answer 100, 125, or 150? How many of you engineers, you should get this all right? Why all the sad faces? Why all the shocked faces? My goodness. Oh no, the answer. It's 150. Divide 60 by 0.4. All right, to get 100%. To get the 100% of this, you divide 60 by 0.4. So remember that. And some of the problems we have when you have the contribution margin per unit and the contribution margin ratio, you can predict the selling price. You don't have to predict, you can calculate it. Let's go. The equation which reflects the CVP income statement is sales plus fixed cost equal variable cost plus net income. Sales minus variable plus fixed equal net income. Sales minus variable cost minus fixed equals net income. Which formula is the formula for the CVP statement? Do I have 17 voters. Oh, I see. People have participated. 30 sad people. Oh my goodness. No, the formula, my dear friends, sales minus all the costs. The costs are variable or the costs are fixed. Okay? That's what gives me net income. One more chance to win. Get your calculator out. Sales are $500,000. Variable costs are 300. What's the contribution margin ratio? First, you have to come up with a contribution margin in dollars. Then convert that to a percentage. What do we get? Now you need your calculator. You can use them on the exams. You use them on the quiz. The exam is next Saturday. We have a lab in Dubai and a lab here in LA. And I will send you an announcement with regards to the room number, the lab number. But the people in LA will be writing the exam in LA, and I will meet you face to face. The people in Dubai will be writing the exam face to face with somebody else, not me. Okay?